Hey there, awesome accounting student. Mark Franke here. This is the Chapter 9 video for Accounting 101. We will talk about liabilities. And this video is going to focus on the payroll side of liabilities. But I want to spend a few minutes talking about the theory behind liabilities in general. We're talking about money that we owe based on a past transaction or event. In other words, we have incurred some sort of a liability in the past we're going to pay in the future. So accounts payable is probably our number one liability most of the time. That's money that we owe based on an invoice from a vendor. Accrued liabilities is based on a calculation. There's lots of different types of accrued liabilities, warranties or vacation pay or salaries and wages that we haven't paid yet, sales tax, property taxes, those kinds of things fall in the category of accrued liabilities. In other words, we don't have an actual invoice, but it's based on some sort of a calculation. Deferred revenue, money that we receive from customers in advance. So that's whenever we get a deposit from a customer for work we're going to do in the future. That's deferred revenue, that's our unearned revenue. Payroll liabilities relate to the hiring of labor, whether it's factory labor or office labor, whatever it is. We'll, we'll go into the details of that in a minute. Notes payable. Notes payable is for if we get a loan from a bank, or if we, for whatever reason, we're not able to pay for some materials or services that we got from a vendor, we could maybe sign a note to pay it off over a year or two, something like that. Then these are usually going to be short-term type of notes. Long-term notes we will talk about in the next chapter, but this chapter is really focused more on current liabilities. And then the last category is contingent liabilities. The word contingent means that something in the future is going to take place that's going to affect this liability. This is typically where we would have lawsuits involved, or maybe if we had warranty issues with our product that we were going to pay for someone to repair a customer's unit in the future. That could fit in here. And there's really three levels of contingent liabilities. If they're probable and estimable, in other words, if they're bound to happen and we know what the amount is, we make a journal entry and record it. If it's possible or we can't estimate what the amount is going to be, that would be a footnote disclosure. And if it's a remote possibility, there's no disclosure at all. So when we talk about a payroll calculation, there are lots of different ways that employees make money working for a company. They can get a salary. This is typically managers or supervisors that earn a salary based on an annual amount or monthly amount or whatever it is. We have hourly employees. This is typically labor. We have contract people that may or may not be employees, but lots of employees have a contract. We could have commissions or tips based on sales or based on volume of transactions. We could pay bonuses to our employees, either a Christmas bonus or a profit sharing bonus or some sort of an additional amount that is paid to employees for their performance and, more importantly, for performance of the company overall. Now, we also have to worry about overtime. Overtime is money that we have to pay for employees for working beyond 40 hours in a week or beyond 8 hours in a day. So Typically, the labor law says that that's going to be paid at 1.5 times the regular rate. So that's why companies like to minimize the amount of overtime. Sometimes it's inevitable, depending on seasonality of the business, but we are required by the labor law to do that. And then the last is piecework. Piecework is based on production, the number of garments that you sew, or the number of barrels of apples that you pick, or something that is based on production or effort. And so we see that in the garment industry a lot and in the agricultural business a lot. Now, we can have different pay periods. Pay periods can be daily, not particularly useful. Weekly, a lot of retail uses weekly pay periods. In other words, they pay people every week. We can do bi-weekly, which means that's every 2 weeks. It could be semi-monthly, which is twice a month. That's a little different than bi-weekly. Monthly, of course, is once a month. Quarterly, every 3 months, and then annually. Now, as far as people's regular pay, their salary or their hourly wages, we can't pay less frequently than twice a month or semi-monthly. Although the government can pay monthly. As a professor, I get paid monthly. The military usually pays people monthly for whatever reason. The government doesn't have to follow that. But for private company businesses, they have to pay at least semi-monthly. Okay, let's get started on problem 9-3B. This is a problem that is fishing guides is the, oops, let's go back here, okay. And this is going to be a payroll register. And this is for the week ending September 30, 2019 we'll use. So there's some working papers in there, and we have 4 employees. We have Ahmed, Carlos, June, and Marie. These are our 4 employees, and we're going to put in their previous pay before this pay period. And the reason we need that information is because we have a wage base. This is going to apply for Social Security tax. Social Security tax has a wage base that is based on, in this case, they're using $128,400. So you can see that Ahmed and Carlos are getting close to that. So once they reach that threshold, we won't have to take any more Social Security tax out of their pay. But for June and Marie, they're not going to reach it, certainly not in this pay period, because our gross wages for Ahmed is $2,500, for Carlos $1,515, for June $475, and for Marie $1,000. So we'll total that up, and let's first focus on Ahmed. I'm going to do Ahmed based on what's in the book, and then you can do Carlos, June, and Marie, and then we'll circle back and you can check your answer. So for Ahmed, his federal tax is $198. Social Security maximum, and this is going to be true for all of them, is $128,400. His previous gross pay was up above. I'm going to pull that down, which means that he has $1,600 worth of wages remaining to be taxed. So we're not going to tax him on his gross wages because his gross wages are more than his the remaining amount to be taxed. So I'm going to multiply that $1,600 times a negative 6.2%. That's $99.20. So for his Medicare tax, there is no wage base. I'm going to multiply that times the 1.45, and then his health insurance is $20. So the net pay there for Ahmed is $2,146.55. $2,146.55. So I will stop the video or pause the video and go ahead and see if you can get the numbers for Carlos, June, and Marie, and I'll be right back. Okay, I'm back, and hopefully when you calculated all of these and added them up, you get a total net pay of $4,565.81. $4,565.81. If you didn't get that number, I would pause the video and go back and check your calculations and see why. But these are the correct numbers. So if you got those, we can go ahead and move on. Now, the way that payroll gets recorded, we have, again, these gross wages, $54.90, and then all of these taxes and the net pay. So the gross wages is going to be a debit, and all of these other items, the federal tax, Social Security, Medicare, health insurance, and the net pay will all be liabilities. So let's go over to the journal, and we're going to make this journal entry to record this payroll. So we've got same company. So I'll just go ahead and pull that. Uh-oh. I guess I have to type it in. And this is going to be dated on 9/30/2019. We will debit salaries expense for the $54.90. That's the total wages. We're going to credit federal tax payable, Medicare payable, healthcare payable, and salaries payable is the net pay. And this is to record wages for the period or something like that. And we would attach our schedule that we prepared over there. So in addition to, now this is just the wages for the employee, but in addition to that, we have employer taxes that we have to pay, and additional employer stuff. So I've got that down below here. And we have, in this case, 6 things. We have Social Security tax, we have the Medicare tax. Those are matched taxes. So those amounts are going to come directly from our other schedule. And so they were exactly the same from up above. Health insurance, the company pays $30 for every employee So the employee pays $20 and the employer pays $30. So the total health care is $50. That's pretty cheap. They also have a pension fund, which is 5%. So I'm going to multiply the gross wages times 5%. And for Ahmed, that would be $125. And for Carlos, it's $75.75. For June, it's $23.75. And for Marie, it's $50. So the last thing we have to deal with is our FUTA tax. And let me make it even smaller so we can put all this on there. But the FUTA tax is the FUTA tax is a federal unemployment tax. The SUTA is a state unemployment tax. And you can see that the FUTA tax is much lower than the SUTA tax, but the wage base for that is $7,000. So I've got my little notes down here that says, okay, so for FUTA and SUTA, it's $7,000. Well, if you look at all four of these employees, Ahmed, Carlos, and Marie, they're way over $7,000 so far this year. So we don't have to pay any FUTA or SUTA tax on those employees. But we do have to pay it on June because June is underneath that threshold. However, she only needs $350 to get to the $7,000. We don't have to pay FUTA tax above $7,000. She's at $66.50, so $350 beyond that, it takes her to $7,000. So we're just going to multiply. So she is going to be at $350 times 0.006 or 0.6%. That's $210. And same thing for her SUTA tax. It's 0.054 or 5.4%, which is $18.90. So if I total these up now and add together with the gross wages, so I've shown these deductions in effect as negative amounts, but one of the requirements of the problem is to prepare the total cost of payroll. So because these are shown as negative, I've now converted them to positive and added them to gross wages to get the total cost of the payroll. So the total cost of the payroll for Ahmed is $2,500 plus the $290.45, which is $2,790.45. So now we can go over and prepare our journal entry to record the employer taxes. And that journal entry is going to look like this. We'll call this employer tax expense. And we've got Social Security payable, Medicare payable, healthcare payable, pension plan payable, FUTA payable, FUTA and SUTA. So those are federal and state unemployment tax. And this is to accrue employer taxes. So I've got total tax expense of $779.69, and then from each one of these, $284.58 for Social Security, $79.61, and you can see they're exactly the same as what we did for the employee. $120 health care payable, $274.50 for the pension plan, and $2.10 for FUTA, and $18.90 for SUTA. Okay, so for some additional practice, let's move to problem 9-6B. 9-6B. And these are going to be payroll journal entries to record accruals of wages, but also what happens when we make payments to the government or to whoever it is that we have to pay. So let me pause the video. I'm going to throw these journal entries up, and then we'll go through them one at a time. Okay, so entry 1 on the 15th of June is to pay the federal government for the taxes from the previous month. So the debits are going to go to the payables, Social Security payable, Medicare tax payable, and federal income tax payable, and then the credit's going to go to cash. We literally sent a check, or in most cases, we actually can go to the bank, which is a federal depository, and then based on the tax ID number of the company, they can just make a payment into the government, and then the government gets it. So on June the 30th, we are accruing, well, actually, we're paying it too. So they said they're paying wages in cash, so we're not accruing it, we're actually paying it as well. We're recording office salaries and shop salaries. These are the expenses. This is the gross wages. And then we are accruing for Social Security, Medicare, and federal tax that we are going to owe to the government. And then we actually handed out cash of $6,338 to the employees. And then we'll have to do the employer portion. And the employer portion of that exact payroll was, let me make this a little smaller so we can look at them both at the same time. There it is. So we only have Social Security and Medicare in this particular situation, and we're recording the employer tax expense of $612. But you can see the Social Security is just a matched tax. Whatever the employees pay, the employers pay. So that's always going to be. Then on the 15th of the month of next month, we're paying off those liabilities we just accrued. We're going to pay off the Social Security, the Medicare, and the federal tax, and we're depositing this money to the federal government through our bank, or writing them a check or transferring it electronically of 2274. Then on the 31st, we have to make a payment for our FUTA and SUTA tax payable that we had accrued and not paid yet. So this is $66 to the FUTA tax and $594 for the SUTA tax, debit the payable, and credit cash. Pretty easy problem. Just wanted to go through these journal entries so you could see how they work, and you can use this for 9-6A. All right, that's it for this video. I will see you again soon. Thanks for listening.